Hey everybody, it's Mark Pruitt with another strategic market update. Well, inflation came in today, this week I'll say, and basically the inflation is at now 8.2. So they were hoping it would be lower. It is not. Surprise, surprise. I'm not surprised, and you probably are not either. But inflation is not done yet. We're not even close to that. So I can tell you this, you should expect the Fed, they will continue to raise rates, interest rates specifically, probably November, December of this year. I would not even count it out that they would raise it again, even in the first quarter of next year, before they even think about pausing on rates, because inflation is hot. I can tell you the big one, there's several big reasons. In fact, Laura will put on a chart for you that you'll see here where you can actually look at the main pieces of inflation of what that was looking at and what was causing it. And when you look at that chart, you'll see where it says food at work or at school. So food, obviously, a big player in inflation. Some of the core categories here as you see the inflation breakdown. Airfare, so going from point A to point B if you are traveling or your own business. If you ever booked a plane ticket lately, you'll see, in fact, somebody was telling me today they were trying to go from Dallas to Nashville and the ticket was $800. That's a lot. That's like something if you normally would go to Hawaii maybe, but not Nashville. But that's where we are right now. The utilities, gas. It's interesting, even the different things, butter, margarine, which is, you think that might be in the food category, but it's not. But you see all these different things. You see the energy sector there. You see food at home. All the different things that are contributing to inflation. So it's not just one thing. It's a whole lot of things. And so that's where the Fed will continue to fight that. And as they raise interest rates, what you're going to see is the 10-year Treasury note and the dollar, if you look at it all year, you'll see it, has risen in value. And that does not bode well for bonds. That does not bode well for gold. If you look at those trajectories, you will see those are down. And normally, in a normal year, you will hear the adage of, well, if stocks are up, bonds are down. Or if stocks are down, bonds are up. And really this year you've got stocks down, you've got bonds down, you've got gold down, and a lot of that is contributed to the high inflation. It is also attributed to the strength in the dollar because of rising interest rates. And so the world, is still looking for interest on their money too. And what it has shown me is that this is not just a United States recession. They're now talking that this will be a global recession. And so 8.2 is for September. That's the CPI, the inflation rate. And there's probably more to come because if you notice, this was for August and gas was down in August. What is gas doing now in September? It is rising again. So that's going to be a higher contributor as well. Another thing that'll be some good news for those that are receiving Social Security is Social Security is about to get a raise of 8.7%. That is the largest raise they've had in 40 years. And so that's a good thing. That's not necessarily going to be year over year, but right now this year, there's going to be a strong bump in Social Security. So that's something that will be coming for 2023, and that was also announced this week. So that's a positive. Markets are obviously down. A lot of this has been the same. We are still, even last week, we took some measures to de-risk even more. Now, if you're younger, again, I'm going to reiterate, if you're younger, you're working, you are in growth accounts. Some of you were even in some aggressive things. We're not moving those. We're going to leave those where they are. We're going to de-risk other pieces of the portfolio. That's what we've done all along the way, and we'll continue to do that. But we've done a lot of it, and there's not a whole lot much more that can be done as far as de-risking, because you've got to be able to see the turn, and you also want to be able to capture some of the things that are moving forward, and that helps us. So you have to look at the long game, and you have to look at the long term. You can't look at just right now. It's like the storm is brewing, and you're in the middle of the storm. It has already come ashore, and now you've taken shelter and taken cover. You have to remember, you still own shares, and those things can rebound, and we're looking for that. But it's not going to be, honestly, in my opinion, it's not going to be as long as the rates are still being raised as far as interest rates by the Fed. They're being hawkish on that, which means they're being aggressive to try and tame inflation. And what I will tell you, you can look at your own history on some of that, but I can tell you a lot of inflation is not always tamed by just raising of interest rates. A lot of it can be done by tightening into a recession. And so, again, no politician out there in Washington is going to want to say, yes, we're in a recession. And so I still held, as I said in the beginning, July 1st, we started a recession. Why? Because the technical recession is 2 negative GDPs, and that happened in January, February, March, April, May, and June. July 1st, we started. I won't be shocked if the third quarter is also negative. That would be 3 negative quarters. So it's going to be really hard for them to continue to say that we're not in a recession, but that'll be up to them. That's not for me to decide. But in my mind, the gun has fired. The race has started into a recession. There's only one question, is how deep is it going to go? This will continue right now as long as they are raising rates. As soon as they stop raising rates and they begin to pull back a little bit, then you'll begin to see that. Don't forget the chart I said. Since 1950 to current, every single midterm year has been down. Again, I'm going to repeat it, since 1950. That included Vietnam War, that included Iraq, that included Carter years, that included Reagan years, and all in between. Every single midterm election year was down. Every single year after midterm elections, markets were up. I just don't think the upside is going to happen until possibly sometime that second, third quarter of next year. So we've got a little bit of ways to go in this storm. So just hang tight. If you've got good income, that's the whole point. Whether you're working to get that income or whether you're retired, income matters, and securing that income has always been and always will be our first priority. If you've got any questions on this, don't hesitate to call. Feel free to give us a holler here at the office, 1-800-381-8870. We'll be more than happy to talk. Thank you for listening. God bless, and have a great rest of the week.